All right, so get this. We're going deep today. We're talking Warren Buffett, specifically his 1998 letter to Berkshire Hathaway shareholders. Right when that whole dot-com thing was going
Yeah,
crazy.
it was a wild time.
Wild's an understatement. But Buffett, he was seeing things differently, and that's what makes this deep dive so interesting, right?
Absolutely. It's remarkable how Buffett navigated that market, all that euphoria going on. 1998 was a big year for Berkshire, huge gains, but then right out of the gate, Buffett injects this note of caution into the letter.
Doesn't he, though? Right away, he's talking about this, what was it, a 48.3% jump in book value per share?
Right.
I mean, on the surface, that sounds amazing, doesn't it?
It does, yeah.
But then he throws this curveball. He's like, hold on, most of that growth, it came from issuing shares for acquisitions, not just purely operational earnings.
And that's where it gets interesting because Berkshire's stock, it was trading at a premium to its book value.
Right.
So issuing those shares, it inherently kind of bumps up the book value per share figure. It's an accounting thing, kind of quirky. And Buffett, he wants to make sure investors really get the full picture.
He does. He wants them to understand the nuances. It's not as simple as just, oh, big number, let's celebrate.
Right.
Buffett's really emphasizing this idea, and I think it's so crucial, that intrinsic value, what a business can actually generate in cash flow, that's the real deal. That's the metric that matters.
Exactly.
Not just some snapshot of assets and liabilities like book value, especially when market sentiment, it can get so disconnected from what's actually happening in the business.
Absolutely, and especially with Berkshire's net worth. Think about this. In 1998, over $57 billion.
Yeah.
This focus on intrinsic value, it becomes even more critical at that scale.
Huge.
They're not looking for small potatoes. They're on the hunt for, as Buffett calls them, elephants.
The elephants, I love that.
Substantial investments that can actually move the needle for a company of Berkshire's size.
He even says, I love this line, popcorn stands just won't do.
Yeah.
So good. But seriously, think about it. To get that 15% annual growth in intrinsic value, which was Buffett's goal, they needed to find something like, what, $58 billion in growth over the next 5 years? That's a lot of elephants.
It is. It really highlights the challenge Berkshire was facing back then.
Yeah.
Finding those elephants in a market obsessed with, dot-com companies, right? All those speculative plays.
Speculation everywhere.
Not easy. But Buffett, being Buffett, he had a few things up his sleeve.
Of course he did.
And one of those things, was Geico.
God.
It's a textbook example almost of Buffett's investment philosophy. You've got this fantastic business model, low-cost auto insurance, and then you've got Tony Nicely, right?
Stellarly.
Leading the charge. But what I find so interesting is how Geico, they were playing the long game, even if it meant sacrificing a bit of profit in the short term.
They understood that long-term vision.
They did. Buffett explains how they invested heavily, really poured resources into marketing and customer service. They knew that building that loyal customer base, that was the key to winning over time.
It's like they were laying the groundwork.
Exactly. And this long-term thinking, it wasn't just in their operations, it was baked into their compensation structure too.
Interesting. Tell me more.
So employee bonuses, profit sharing, they were significantly tied to the growth in policyholders, not just the earnings they were pulling in at that moment. It's like they created this system where everyone, from top to bottom, they were incentivized to think about sustainable growth, not just quick wins.
They were all pulling in the same direction.
Right, and you can see the results. In 1998, Geico's profit-sharing payout, it hit a whopping 32.3% of salary.
That's incredible.
It really shows Buffett's belief in finding exceptional managers, empowering them, and then rewarding them for building lasting value.
It's a win-win. You create value, you get rewarded. But Geico, that was classic Buffett, right? That value play, that long-term vision. But then in 1998, he makes this other acquisition a bit more intriguing.
Right.
Executive Jet Aviation, EJA.
EJA. Yeah, and the story behind this one is kind of fascinating. Buffett, he actually became an EJA customer before he even thought about acquiring the company.
Wait, hold on. The famously frugal Warren Buffett, he was flying private. I did not see that coming.
It is a bit surprising, right?
Yeah.
But it speaks volumes about EJ's value proposition. Buffett, he experienced firsthand how their fractional jet ownership model, it made private air travel accessible, cost-effective, even for someone like him. And he realized, this isn't just some personal convenience. This is a smart business model.
Right.
This has huge potential.
Okay, now I'm intrigued. So for those of us who aren't, billionaires flying around on private jets, break it down for us. What exactly is fractional jet ownership, and what made EJA stand out in the market?
So essentially, it allows individuals or corporations that can buy a portion of a jet. This gives them access to a certain number of flight hours every year. Think of it like, I don't know, a timeshare, but for private jets.
Yeah.
You get all the perks without the massive cost of owning the whole thing outright.
I see.
And EJA, they were the big players, the industry leaders. They had this vast, diverse fleet that gave you all sorts of flexibility depending on what you needed to do, where you needed to go.
That's what Buffett called the virtual fleet option, right?
Right.
It's like having your own personalized air travel concierge service.
Exactly.
And given how fast that whole fractional ownership industry was growing back then, it's pretty clear why Buffett saw EJ as a business with a long runway for expansion.
Exactly. He was tuned into those emerging industries, those ones with disruptive potential. But we can't forget the other big acquisition that year, 1998, and this one was massive. General Re.
Huge.
This moved Berkshire into the world of reinsurance, which is basically, insurance for insurance companies. And Buffett, being Buffett, he saw an opportunity there that others might have missed.
Unique angle.
Yeah, so Berkshire, they've got this immense capital strength, right?
Deep pockets.
Deep pockets. And that became a huge advantage for General Re. It allowed them to write these bigger policies to handle more volatility in the insurance market. And if you remember, Buffett's always said he prefers the possibility of those, what did he call them? Lumpy returns. 15% returns, even if they're a bit unpredictable, over those steady, smooth 12% returns.
He's willing to ride the waves a bit.
He is, especially when he's got that financial strength to back it up. But amidst all these big acquisitions, the market analysis, Buffett takes this sharp turn in his letter. He dives into something that, let's be honest, clearly gets under his skin. Accounting shenanigans.
Oh, yeah. This is where we see Buffett, the advocate for transparency, the champion for ethical accounting, come out swinging.
He does. He was really critical of companies using accounting rules, kind of twisting them to mislead investors, especially when it came to stock options.
Right, stock options. He had this brilliant analogy, do you remember?
Okay.
He talked about Geico paying for advertising with stock options instead of cash.
Right.
And it's like, come on, that's a real expense.
Of course.
But back then, companies weren't required to actually expense those options, even though they represent a real cost to shareholders.
It's a real cost, absolutely.
So Buffett's argument, he's saying this practice, it distorts the true earnings picture. It's essentially a form of, what did he call it, earnings management?
Right. He's not a fan. He's a huge advocate for accurate and honest reporting. Transparency is key.
Transparency is key, and his criticism didn't stop there. He also goes after, and this was a big one at the time, the whole restructuring charges thing.
Oh, yeah. He compared it to a golfer, manipulating their scorecard.
Oh, I remember that. So good.
Like, you take these massive charges, you wipe the slate clean, so to speak, and then conveniently, you just kind of ignore those charges when you're reporting your earnings later on.
It's like taking a mulligan on a really bad hole.
Right, but pretending it never happened.
Exactly. And Buffett, he saw right through this. He called these practices out for what they were, a way to prioritize how things look over how they actually are.
Prioritizing appearances over genuine performance. And that's where you really see Buffett's commitment to ethical business shining through. He wasn't just concerned about the financial implications, but about the erosion of trust, the damage it does to the integrity of the whole business world.
He's a champion for doing the right thing. But we've just scratched the surface here. There's so much more to unpack in this letter. Okay, so we've talked about those big acquisitions, Geico, EJA, General Re. But let's not forget about all those businesses that, they were kind of the foundation of Berkshire Hathaway, right? Even before those massive deals came along.
Yeah, you're right. Buffett, he actually spends a good chunk of this letter praising those operating managers.
He does.
He calls them legends in their industries, even compares them to, get this, the Mark McGuires of the business world.
High praise, especially coming from Buffett. I mean, it's clear he's got immense respect for these folks. He trusts them, trusts them to actually run their businesses effectively.
Yes.
And I think it's interesting the contrast he draws between their approach, hands-on in the trenches, and his own role, which he kind of describes as what, capital allocation.
Right.
He even jokes about how he and Charlie Munger, they just kind of, and I'm paraphrasing here, wait for the phone to ring.
Well, allocating capital wisely, that's no small feat. It
Mm.
takes, a deep understanding of businesses, industries, the whole market landscape.
It does, it does. But it does highlight this philosophy, and I think this is so important, of finding talented people, empowering them, giving them the freedom to really shine.
It's about creating that culture where they can thrive,
Yeah.
free from those, short-term pressures that often plague public companies.
Right, no pressure to just hit those quarterly earnings targets. But speaking of distractions and maybe annoyances, Buffett does circle back, and this is no surprise, to those accounting practices he finds so, let's just say, misleading.
Yeah, he does. In this section on, what does he call it, sources of reported earnings, he really gets into why investors should be careful, why they shouldn't just blindly trust those numbers.
You got to look beyond the surface, right?
Exactly. He argues that GAAP, generally accepted accounting principles, they can actually obscure the true economic reality of a business. And he points to, this is an interesting one, purchase accounting adjustments.
Okay, so break this down for us. Purchase accounting adjustments.
All right, so imagine Berkshire acquires a company. They usually pay a premium over book value, right? And GAAP. Well, it requires this premium to be amortized over time, which basically reduces those reported earnings. But Buffett, his argument is this amortization charge is not a real economic loss.
It's more of an accounting quirk than anything.
Exactly. It's a purely accounting-driven distortion. It doesn't actually reflect how well the acquired business is doing. And remember Buffett, he's all about focusing on those underlying operations, stripping away all the accounting noise.
He wants to get to the heart of the matter, the core of the business.
Exactly. And it's another example of this commitment to transparency. He's not just trying to make the numbers look better. He genuinely believes that this approach, it gives investors a clearer picture.
An honest picture.
Right. He wants them to understand the businesses, not just the numbers on a spreadsheet.
Understand the story.
Right. But let's shift gears a bit, move on to the section on investments. This is where we get a glimpse into Buffett's stock portfolio in 1998.
Oh, this is the good stuff. This is where we see those big names, the ones we associate with Buffett, with his success. Coca-Cola, American Express, Gillette, Disney, the Washington Post Company.
Yeah.
It's like a who's who of blue chip stocks.
It is, but there's also this interesting confession he makes in this section.
Oh.
He admits to making a pretty big mistake.
No way.
He sold his shares in McDonald's.
McDonald's.
Yeah. A decision that, well, it actually hurt Berkshire's overall gains that year.
It happens to the best of us, I guess. It's a good reminder that even the, what do they call him, the Oracle of Omaha, he's not infallible. Everyone makes mistakes, and honestly, it's kind of refreshing to see him acknowledge it.
It is.
But besides those big name stocks, there's something else interesting here. Buffett reveals that Berkshire, at this point, they're sitting on a ton of cash.
A mountain of cash.
Over $15 billion in cash and equivalents.
Yeah, and he's not exactly thrilled about it.
Yeah.
Buffett, he'd rather have that capital working, deployed in productive assets.
He compares it to, and this is classic Buffett, money burning a hole in Berkshire's pocket.
Yeah, he's eager to find those elephants, those big acquisitions, those significant investments, but they just weren't there. Not at that moment.
It's tough, right?
It is. It really highlights the challenge of investing at that scale.
When you're playing in the big leagues.
Right. When you're managing tens of billions of dollars, finding those game-changing opportunities, it's not easy. But even with that frustration, Buffett emphasizes, patience, discipline. He's not going to just jump into a bad deal just to put that cash to work.
He's sticking to his guns.
Exactly. He stays true to his principles, his focus on finding the right investments at the right price. Even in a market where everyone's, chasing the next hot thing, he even cautions investors against, trying to follow his every move.
Oh, interesting. What did he say?
He basically says, look, all this media speculation about what I'm buying, what I'm selling, it's often inaccurate. And besides, if I start talking about my specific moves, it's just going to hurt Berkshire shareholders.
So don't just follow the herd.
Right. It's a good reminder that investing, it's not about mimicking someone else. It's about understanding those businesses, doing your own analysis, making informed decisions based on your own assessment.
Be your own Warren Buffett. Well, not literally, but you get the idea.
Right. But okay, so we've talked about the big picture stuff, but now Buffett, he dives into something that's been, well, a cornerstone of Berkshire's success, Insurance.
And with the addition of General Re, this becomes even more important for them.
It does. It does. And Buffett, he wants to make sure investors really understand this business, all the ins and outs. He starts by explaining this concept of float.
Okay, float. Always a bit of a head scratcher for me. Break it down.
So float is basically money that an insurance company holds, but they don't actually own it.
We're just holding on to it.
Right. They collect it up front in the form of premiums, but they don't have to pay it out immediately in claims. So in the meantime, they can invest this float and make some money.
Free money, almost.
Almost. The cost of float is the underwriting loss. That's the difference between the premiums they collect and those losses and expenses they eventually pay out.
Got it.
So for an insurance business to be truly profitable, those returns they generate from investing the float, they've got to exceed the cost of that float.
Make more than you spend. Makes sense.
Right. And what's impressive is that Berkshire, they've been doing this consistently.
They've been playing this game well.
Yeah, Buffett reveals that over the past 32 years, their average cost of float, it's actually been below zero, meaning they've made an underwriting profit.
That's a heck of a track record. They've been paid to hold and invest this huge pool of money.
Yeah, but as with everything else, Buffett, he doesn't sugarcoat things. He warns investors about the difficulties of evaluating insurance companies. Figuring out those loss costs. It involves a lot of judgment, potential for error.
It's not as simple as it might seem.
It's not. He stresses the importance of being conservative, when setting aside reserves for potential claims. And he warns against just looking at those reported earnings, at face value, to assess how profitable an insurer really is.
Do a little deeper.
Yeah, he even criticizes those auditors for sometimes overlooking overly aggressive reserving practices. Again, we see Buffett, the champion for transparency, wanting those investors to have a realistic understanding.
Not just painting a rosy picture.
Right. He wants them to be able to tell the difference between real profits and accounting illusions.
Solid advice. But amidst all this talk about business, about profits and losses, there's this section that I found really interesting. It gives us a glimpse into, I don't know, a more fun side of Berkshire Hathaway.
Oh, yeah.
The annual shareholder meeting.
Ah, the legendary, what do they call it?
Woodstock for capitalists.
That's the one. Even back in 1998, this thing was drawing huge crowds.
Huge. And Buffett actually talks about, all the logistics, booking multiple venues, arranging transportation, setting up exhibits, making sure everyone can hear him and Charlie answer questions for hours on end. It's clear this meeting, it's not just some formality for him.
No, it's an event.
He's creating an experience for his shareholders, a chance for them to connect with each other, to learn about Berkshire. And yeah, to have a little fun.
It's a smart move.
He even mentions setting up a one-company trade show to showcase products from all those Berkshire subsidiaries. Sees candies, Dairy Queen, furniture, jewelry, everything but the kitchen sink, it sounds like.
It's a brilliant way to show off the diversity of Berkshire's holdings, to give those shareholders a chance to actually experience those brands firsthand.
And then there's that classic Buffett humor where he mentions participating in a baseball game, suggesting he's this great athlete.
Okay, that's good.
Love that self-deprecating wit. But beyond all the fun and games, you can sense this deep respect he has for those investors.
Yeah.
He wants them to feel like they're part of something special, part of this community of, like-minded individuals who share that long-term investment philosophy.
It's a community.
It is. It's a reminder that investing, it's not just about numbers and spreadsheets.
It's about believing.
It's about connecting with companies, with leaders you believe in, sharing in their success. We've covered a lot of ground here, but we're not quite done with this deep dive. There's still more to explore in Buffett's 1998 letter.
Yeah, especially how those insights, how they apply to today's market.
Okay, so here we are. The final part of our deep dive into Warren Buffett's 1998 letter to Berkshire Hathaway shareholders. We've talked about acquisitions, managing businesses, those counting quirks he loves to point out, even his approach to shareholder meetings. But now, I think it's time to step back a bit, look at the big picture, see how those insights from 1998, how they hold up in today's market.
Yeah, it's fascinating, isn't it? So much of what Buffett was saying back then, it's still relevant today, even though the market, well, it's changed a lot, hasn't it? One thing that really stands out, though, is his emphasis on intrinsic value. I mean, he really hammered that point home, didn't he?
Oh, absolutely. It's all about the fundamentals, right? The earning power of the business, not just chasing the stock price. He wanted investors to think long term, to ignore all that short term noise, all the distractions, to find those companies with a real edge, the ones that can just keep generating profits year after year.
It's almost like he could see the future coming, you know? With all the algorithmic trading we have today, the social media frenzy, it's so easy to get caught up in the hype.
Oh, it is. I'm guilty of it myself sometimes.
But Buffett's letter, it's like this voice of reason, isn't it? Reminding us to stay grounded, to do our research and invest in those businesses we truly understand, the ones we believe in for the long haul.
Absolutely. It's a good reality check.
Yeah.
But beyond those investing principles, Buffett also gives us some really valuable insights into leadership, into management. I mean, he praises those Berkshire managers constantly, talks about their integrity, their passion, their commitment to the long term.
He really values those qualities, doesn't he? And you can tell he views those managers as partners, not just, employees. He trusts them to make the right decisions, to run their businesses with the same care he would. It's a pretty decentralized approach, really.
Yeah.
But that's a big part of Berkshire's success.
It is, and I think it's a great model for any leader, really. Find those talented people, empower them, and then, well, get out of their way, let them do their thing. Create that culture of accountability where everyone's focused on building real value, not just chasing those short-term wins.
It makes sense, doesn't it? But it goes beyond just managing people, too. Buffett, he also talks about how important it is to communicate clearly with shareholders. He doesn't just give you the numbers, he explains his thinking. He talks about the challenges, the opportunities. He even, admits to his mistakes.
He's very open about that, which is refreshing. I mean, he's managing billions of dollars, but he still comes across as, I don't know, relatable. He's not trying to hide anything. He's bringing those shareholders along for the ride, showing them how things work.
It's a good model for any company, really. Be transparent, tell the story, build that trust. Don't just hide behind the numbers.
Exactly. And finally, and I think this is a big one, Buffett's 1998 letter reminds us about the importance of patience, of discipline, especially when it comes to investing. Remember, he was talking about the challenge of finding those elephants, those big acquisitions that can really move the needle.
Yeah, but he wasn't going to compromise, was he? He stuck to his principles.
He did. He was willing to sit on all that cash, even if it meant missing out on some deals, until he found the right opportunity at the right price. That takes discipline.
It does. In a world where everyone wants everything right now, it's a good reminder that sometimes the best approach is to just wait. Be patient, be selective, wait for that perfect pitch.
I like that. Wait for the perfect pitch. So as we wrap up this deep dive into Warren Buffett's 1998 letter, it's hard not to be impressed, His insights, his integrity, his commitment to building something that lasts, it's inspiring.
It is. And honestly, this letter, it's worth reading, even today, not just for the historical perspective, but for those timeless lessons. Whether you're an investor or a business leader, there's something in there for everyone.
Absolutely. It's a testament to the power of, well, clear thinking, ethical leadership, a long-term perspective, things that never go out of style.
Thanks for joining us on this deep dive.
Until next time, happy investing.